Well, good afternoon, everyone. We'll get going again here this afternoon. My name is Carl Potts, and I'm Executive Director with Saskatchewan Pulse Growers. Thanks and welcome to everyone who is joining us here this afternoon. But before we get started, I just wanted to remind that those attending in person is that if you're joining us for multiple sessions, we ask that you stay seated in the same seat at the same table for the duration of your stay. We also ask that you always keep your face mask on unless otherwise directed. There's going to be a question period at the end of the Market Outlook session. And for those joining us virtually today, to request a question, we ask that you use the raise hand function located at the bottom of your Zoom window. Permission will be given in the order in which requests are received, and you'll have the opportunity to ask your question live over the webinar. For those joining us here in person, to request a question, we ask that you raise your hand, and once acknowledged, please proceed to one of the two standing microphones located in the room. We kindly ask that you keep your face mask covering on during the time when you're at the microphone. Our Market Outlook session this afternoon will be presented by Chuck Penner from Left Field Commodity Research. From international movement and demand to local production numbers, Chuck will provide the latest market demand and outlook on pulses. Please join me in welcoming Chuck Penner.
Thanks very much, Carl. It's good to see you again, sort of. Look forward to when we can actually see each other face to face. But yeah, it's good to be with you. And so I will. I'll jump right into this and get going. So just wanted to confirm that we're good for sound and for the PowerPoint.
You got it, Chuck.
Excellent. Okay. So for those of you who, well, some of you who have been here for the last presentation, the Wheat Outlook, and for those of you who are at the Canary Seed AGM earlier today, I had the same question twice, and I'm apologizing to Dave. I'm really hoping he's on this one as well too. So I'll give him, hopefully I can finally answer his question properly the way that he was asking it. But we're going to look at a number of things today, and I want to answer Dave's question before we go any further. And he was asking about maps that show the current soil moisture or the latest soil moisture situation versus a year ago. And now I was, during the little bit of a break, I was frantically trying to find that. So I found it. So I'm going to pop it in there, and I think I know now why he was asking that question. So if you look at this, this is as of the end of November, but in 2021 year, or this just the November 2021, and then on the right hand side is November 2020. So you can see it's just a little bit more precarious kind of a situation this year. Actually, and I'm exaggerating wildly, it's far more precarious this year. So Dave, I hope I answered your question now. I hope that's what you were asking. And I'm glad you did, because it sets the stage for a whole bunch of other thoughts and whatever as we get further into this presentation and the last one as well too. So yeah, that's appreciate that question. So what we want to do now is we want to look at a little bit what's happening the rest of this year. So some current supply and demand type of factors that are going on, an outlook for next year, and then also some of the longer term ripple effects. So if there are things that this year has caused or things that have developed this year or whatever, and how they might go even beyond just the next year. And so we want to do that. And so the crops that we're going to cover: peas, lentils, chickpeas, and I'm going to throw a few slides in there at least for fabas. So I hope that's again what is requested of me. So and even if not, that's what I'm doing anyway. So in terms of the Canadian pea crop this year, what we have is you had a crop that was roughly half of the year before, so 2.26 million tons. And so it's the, I don't even know when was the last time we had a crop that small, but it was a severe drop. And the yield shown by StatsCan came in at 22.5 bushels per acre. So little less than half of what the normal is or the average is what last year's was. Production was down more so for greens and for minor classes than for yellows, at least according to what StatsCan showed for yields and for acreage numbers for those classes. So in theory, supplies should be tighter for, or that you would think that would mean tighter supplies for greens, but that's not necessarily the case, partly because there was more carryover from the previous year for greens. So when we look at supplies this year, down for both, down sharply. The total decline for both types was a little over 2 million tons in terms of supplies, but the proportionately was greater for yellows than for greens. And so that's why you see some of the price disparities or the yellow price premium versus greens. So what that means in terms of exports is sharp declines. And so essentially we've ruled India out. Well, it wasn't just this year, it was last year as well. And we've also cut back sharply in terms of other Asian countries. And this is some forecasts. China also dropping their imports considerably compared to last year. The one that isn't dropping and is likely actually going to grow is exports to the US, and I'll show you some more slides in a little bit. But essentially, the 21-22 export program had to be cut in half, and so that's or almost in half. So that's the kind of situation that we had. So essentially, what has to happen then is prices rise to start rationing demand, and as you can see again, rationed from China, rationed from other Asian countries mainly. That's where most of that happened. Here's what's going on in the US. So this chart shows USP exports are the blue bars on the top, and their imports, which are the red bars underneath. And so what you had is they've always been a bit of an export or larger exporter than importer, or mainly been that way, but that balance has really tipped. And the November data, which is in the far right there, they imported 82,000 tons of peas, and that includes 20,000 tons from Ukraine. And we had heard about that earlier, seen some reports about that, and that may not be all of it just in the November. I think there's more to come in the months ahead, and simply because Canada can't supply them. Or the Canadian prices have reached a level where it actually makes sense to bring them in from Ukraine. And really what's happening in the US is that this domestic processing that we've been talking about and been getting excited about is ramping up there. And so that tends to be quite inelastic demand. So those peas are going to get fractionated or milled regardless, and so that's where the biggest part of the demand, or the strongest part of the demand, put it that way, is what's driving the highest part of the price curve right now. So that's what we that's one of the big factors and the new factors this year. And it's because the US also had a crop failure. So that's also what's driving that. I would guess that probably they'll import maybe in the neighborhood of 400 to 500,000 tons in their marketing year, which runs from June to next May. So that's quite a new thing. The other thing that's happening is that other exporters are responding to the Canadian shortfalls, and particularly Russia and Ukraine. And so you see in September and October, and I would imagine even back in August, and even into as we go forward, above normal exports out of the Black Sea region. And a good chunk of that is going into Western Europe. A good chunk of that is feed peas going into Western Europe. But as we saw, some very unusual trade patterns where Ukrainian peas are moving into the US. So far, we've only seen some glimmers or some rumors or reports of Black Sea peas being allowed into China. That is another possible issue with longer term implications, but I'll talk about that a little bit further later on. When it comes to China, these are their pea imports over the last number of years, and these are calendar years. So what we had is this record imports of almost 3 million tons in the 2020 calendar year. We had a very, very strong start to the first half of 2021, and then it leveled off. Then we had a bit of a surge again as the Canadian harvest hit the market or was available for export to China. But really, as we look forward, and there's a bit of a delay in terms of when Canada exports and they arrive in China, but that curve is going to very much turn sideways again. And so for their 21-22 marketing year, volumes will be cut back significantly. So if I would redraw the chart with those kind of timeframes, that would you'd see a much sharper decline as we go forward. In terms of domestic use, and this these are some estimates for Canadian and for US domestic use, and this includes feed and also the feed use and the fractionation and the milling and all of those kind of things. So we see a bit of an increase. I would expect less feed use just because of the extreme prices, but more so for that processing type of use. So that includes the plants that have started up, but for the most part, they're just trying to get up to full capacity now. They're finishing their commissioning and all of that kind of stuff, but also in the US. And so it would be nice if we could get some estimates of the actual amount that's going into those industries aside from feed, but regardless, the total amount is still climbing, even if the feed use is down. In terms of ending stocks for this year, I'm expecting minimal, almost no yellow peas, but there is a bit of a caveat in that, and that's in the little comment there, as long as we haven't rationed demand too much so far. And so $17 yellow peas, we've taken out a whole chunk of demand by having bids that high, having prices that high. And a good chunk of that is in China, but also from some other countries as well too. And so we'll be watching that very carefully as we go forward, how the trade levels off. So there is a possibility that we've taken out too much demand. And what that means is that later in the year, we could start to see prices start to soften. These are some global prices in a whole bunch of different markets. So the light blue line is in China, Chinese port, Qingdao, but then you also have this Saskatoon. These are farmer bids right now, and they're higher than in North Dakota. This is all in US dollars per ton, higher than in prices in Italy, prices in France. So Canadian peas are actually at a premium. And so when I say that we may have rationed too much demand, peas from other origins like Ukraine and Australia are considerably cheaper than Canadian peas. So if we push too much demand toward those other origins, then we could end up with hanging on to more peas than we thought earlier. So it's and we've seen this in not just in peas, but in some other crops as well too. And so that's a bit of a warning signal, is that no, the world doesn't have to pay $17 or $18 for yellow peas, or a portion of the market doesn't have to. There are some other alternatives, although supplies from those other origins aren't unlimited either. So here's what's been happening with Canadian exports. These are bulk pea exports, so they're what go and get dumped on a vessel, a bulk vessel. They're not container movements. But what we have is we had a good strong start, but it's really flattened out since I'm going to say mid-November. And so what that means is that there's not fresh demand. So what we had is this early stage where we had some good movement, these were yellow peas that were bought by China back in spring, before there was ever, well, there were people worried about drought, but before it was ever becoming serious or locked in or irreversible or anything like that. So these peas were all sold earlier. And now we're into the stage of year where we need fresh demand. So that's, again, we'll keep tracking this fairly carefully to see whether we're going to end up with sitting on more peas at the end of the year than we thought otherwise. In terms of some seasonal price indications for green and for yellow peas, that's the dashed lines here, the green peas, and they both follow roughly the same pattern. So what we had was last year we had in early 2021, they followed those markets or the seasonals fairly closely, although the scale on this chart kind of plays havoc with being able to see that. And then as soon as we got into July, when we realized, okay, these yields aren't going to come back now, even if we get some rain. That's what really drove those prices higher. So we followed the seasonal tendency, but we started a bit earlier. And then what happens seasonally is we see that prices kind of move even a little bit higher yet into the early stages of the calendar year. And so that's where we're at now. We're kind of in this January timeframe where we could see prices tend to move sideways-ish. But again, there's less demand at these kind of price levels. And I see a question from Jared about the long-term demand destruction. I will touch on that a little bit later. So I'll try and touch on that. So I'm not ignoring it. I just won't go there quite yet. So in terms of the outlook for this next year, there's really almost no new crop bids for green peas right now, and only a few on yellows, and they range from $11 to $13 a bushel roughly for new crop yellow pea bids. So we're expecting a small increase or recovery in seeded area from last year. Part of that, I mean, I understand there's all kinds of things about nitrogen costs and how that could play havoc or push acres toward pulses. But then there's also still disease issues that will limit the increase, and a whole bunch of other things in terms of crop rotations. But we're expecting maybe a 5 or a little bit more % increase in seeded area. But what we also have is, and I've talked about this with other crops that we've talked about today, is this drag effect on yield, and really the long-term yield numbers suggest there's greater odds of below average yields again next year or in 2022. So right now we're forecasting a 5% below average yield already for next year, whereas normally we use average yields at this point. And here's again, I showed that map right at the front end, but here's the % of average precipitation from the beginning of November to January 4th. So we went into the fall with very dry conditions, and in a lot of areas, many areas, we're below average even through the first couple of months of winter. So it's not getting any better. And so we need a turnaround soon to give a better, a more optimistic outlook. But what that means is if we use those lower below average yields, and those even with increased acres, supplies of both yellow and greens, this includes minor classes as well, but supplies of both aren't going to get back to where we were for the previous 5 years or so. So we're in a tight situation regardless, even with more acres. I mean, we could have a fabulous spring and timely rains all summer and that sort of thing, which will help. But right now, anyway, that's the outlook that we're using. So some of the things that we kind of know are that we do have this firm domestic use in Canada and in the US, and that's great because that's the inelastic demand. It's kind of like the canola crush demand, where they are when supplies get tight, they are the most aggressive bidders. So that's positive. I think we'll see some acreage and a production response, both in not just in North America, but these high prices will tend to encourage more production in the Black Sea region, for example, and maybe it's in Western Europe as well too. China is looking for more sources, and so that was already happening before this year. But now that we've had this drought, they are going to they have increased urgency in terms of looking for more sources, and I will touch on that a little bit more. There is a shift in farmers' selling behavior. So in terms of thinking about forward contracting, even if acres go up, forward contracting is going to be only a fraction of what it was last year. So that means there's going to be a whole lot more uncontracted peas sitting around next year. And hey, I'm not debating that at all. I'm not questioning that. I would put I would probably feel the same way. And there have been pain for all parts of the supply chain. So not just farmers, but the buyers as well too. I know there's a lot of strain on the system right now for a whole bunch of reasons, not just the drought, but transportation issues as well. But there really is no cushion for adverse weather in the next year, and we're already starting from a deficit. Some of the longer term questions, and again, I touched on this, the Chinese demand, is it going to come back or will it come back to Canada? And if so, at what price? So if China imported roughly 3 million tons of peas in 2020, then about half of that, and that's a real rough guesstimate, about half of that was feed demand. And so that, as soon as yellow pea prices got up to where they were, that demand just evaporated. So it's really using peas for protein, for fractionation essentially, and the rest of that Chinese demand has disappeared. So when will it come back? Will it come back at what price? And where will its sources be? So there have been numerous reports of China loosening phytosanitary restrictions on Black Sea peas. And I think, again, that urgency is greater now than it's ever been. And that is a longer term demand situation. And again, it wasn't just a drought related thing. That was already a move that China was starting earlier, but it's picked up the pace now. And I think I saw in some recent Ukrainian export trade that very small volumes were now moving into China. So there may have been some test cargoes and that type of thing. So I would expect that business to become a lot more competitive. Similar to the flax market, where Canada used to own that whole market, and now actually this year Russia dominates it with 85% maybe of China's imports. So similar type of a situation where China just wants to have more origins, and just like Canada wants to have more destinations, more diversified destinations, China wants to have more diversified origins. So will those changes in trade patterns become permanent? I think they will, frankly. This year has been pretty weak demand for greens. And I always thought that the demand for green peas was quite inelastic. But so far, Canadian exports of greens are about half of last year. And it's not necessarily because there's no supplies. And we see it in prices that green pea bids are lower than yellows. So it's not that there's just no supplies around. The demand has been kind of weaker, and I'm puzzling over why that's the case. The good news is steady to stronger domestic demand. How big the upside potential is, I don't know yet, but it is nice, solid demand. And then a longer term idea is that is there a ceiling on Canadian acreage, largely related to agronomic issues and disease related issues in particular, unless there are significant advances made in terms of Aphanomyces resistance. But other countries don't necessarily have those same kind of constraints because peas haven't been as big a part of their rotation. And so again, I think we're going to see more competition coming from other origins in the future. So those are some of the longer term ideas related to peas. When it comes to lentils, we had a sharp drop there as well too, that we went to a crop of about 1.6 million tons from about 2.9 the year before. Green lentil production was down by more than half and red's down a little over 40%. And yields came in at, where are we here? I'm just looking at my spreadsheet here, 835 pounds an acre, which is just under 14 bushels an acre. And so that's the kind of situation. So no surprise to anybody in the room, but that's the kind of situation that we had. So supplies this year, green lentil supplies down almost 60%, yellows down almost 45%. And what that means is sharp drops in available or possible exports from last year. We were carrying over some decent supplies, so the export programs don't have to drop as far as the supply levels do, or as the production levels drop, but pretty significantly. Then we also had a very sharp drop in the US yields, and they had more acres, so it partly offset those lower yields, but still the smallest crop in, I'm going to say 6 years. And so there, in terms of green lentils, green lentil exports, Canada and the US are really the only two major exporters. And so both of those major exporters saw smaller crops. In terms of Australia, what we have is the purple bars there are exports and the blue bars are production. And the blue bars are the official production estimates. And you can see a pattern developing over the last 10 years is that many times, most years actually, exports have exceeded production, which just tells you that the production numbers are out of whack. And so what we're expecting that this year, production was estimated at about 650,000 tons by the Ag Ministry. It's probably closer to 1 million tons, because this chart doesn't even allow for any domestic use, any seed use, anything else, any carryover. And so it's just the numbers are wildly out of whack. So I would expect it will probably see close to 1 million tons, and almost all of Australian lentils are red lentils. So they compete in that portion of the market. Indian lentil imports. And so we had really been counting on India being a larger buyer. We thought their crop estimate was overstated. But so far anyway, through the first 6-7 months of their marketing year, their imports have been lower than the past 2 years, than both 2021 and 1920. And so that isn't necessarily related to the fact that Canadian supplies were low, because Indian lentil imports already were weak well before the Canadian crop was well, as it was planted and before it ran into real problems. So there was already weakness in terms of Indian lentil imports. So that's a bit of a worrisome signal. And this chart includes both green and red lentils. So will it pick up? Well, I'll show some things in a little bit anyway. Turkey did have a considerably smaller crop, and there are already concerns for its next crop. So also some dryness in southeastern Anatolia, where the red lentil crop is grown. And so that's where we were really expecting to pick up or replace some of that weaker Indian demand. The problem, though, of course, in Turkey is the economic, the monetary turmoil that's going on there that makes imported lentils much more expensive, and simply the volatility in the lira from day to day, from week to week is extreme, which tends to make traders a whole lot more cautious. So we think the demand would be there, but right now all of this other turmoil is causing some restrictions or limitations in terms of their demand. So we don't know how long that's going to carry forward, though. So their imports, they tend to spike in spring. If we look at this chart, so March, April timeframe is when they normally tend to spike, but we don't know for sure that they're going to do that this year again, or to the same degree, maybe, put it that way. So so we'll cross our fingers and hope for some stability there, but never a sure thing. When we look at red lentil prices in a number of key markets, so Saskatchewan and Australia and Turkey, and so you can see the when you convert to US dollars, the volatility in Turkish prices has just been absolutely ginormous, and so it's again, that's making traders a lot more cautious. The purple line is India, and the blue line is Karachi in Pakistan. So what you see is that we had this spike early in the year, and then in a whole bunch of these markets, prices have worked their way lower from there. So not entirely surprising that Saskatchewan prices or bids in Western Canada have been weaker, but we've also had that even with transportation, larger transportation costs, Saskatchewan red lentil prices have been exceeding prices in Australia for a little while, and then they've come together a little bit. Now they're working their way apart again, and so what that means is that Saskatchewan prices are somewhat uncompetitive in markets like India and like Pakistan and some of those other South Asian countries, and so right now Australian lentils are kind of showing the greatest or are the most competitive. So that's not entirely friendly for red lentil prices here. In terms of some seasonality, the green lentil prices tend not to show as large fluctuations in spring, but we have experienced those fall increases. The peak for red lentils actually tends to be kind of that May timeframe, and so what we have, again, this year is very different than normal. So whether or not we can hit this peak again, I don't know that we can see a large increase, but I would expect that we'll probably see some local, some temporary or short-term kind of strength in bids as shipments need to get filled, and then that'll allow some of that increase. In terms of the Indian lentil crop, which is the planting is just wrapping up now, and so they had some heavier rains early in the Rabi season. So at the beginning of the season in November, this year's planting pace was trailing average, and then it's kind of worked its way, caught up to, and then now is I believe about 4% above average, and so that's 4% is not a huge difference. It's really more the weather that's going to tell the tale in terms of Indian planting. And so what you have is rainfall from the beginning of October to the end of December in India, and to a large degree, most of the country is above average rainfall. Some of this happened very early in the season, but has just now started to pick up again. This is their dry season, but it's still, they're running above average, and lentils tend to be grown in kind of this north central to northeastern parts of the country. So there are some drier or normal spots, but there's a lot of above average rainfall too, which as long as it dries up in time, it should be fairly positive for their crop. When we look at Canadian lentil acres, we're expecting a small increase, maybe 3%, but again, there's a lot of differences of opinion about that and how nitrogen prices will play into effect versus ongoing disease concerns and regular rotation, things like that. And just like for peas, because of the dryness and the yield drag effect, we're still only forecasting yields for this next year, or we're using that as our early forecast anyway, 5% below average. So a muted yield response is the most likely situation for 2022. So that's what we're looking at, and increases in each of the various classes, small increases for acres of each of the classes, because the green lentil premium over reds is enough to keep acres there, and we'll see. But again, farmer contracting is not going to be a useful signal in terms of what acres are doing, because farmers are going to be very reluctant to forward contract. So with a cautious yield, there's still not a full recovery in supplies for reds or for green lentils. So recovery from last year for sure. Well, for sure, who can predict what the weather's going to do? But most likely, but below the 5 or 6 years that we've had prior to that. So a tight-ish supply situation again as we go into next year. Oops, I got my years wrong on them. This should be 2020, 22, 23 in this right-hand column. Just a mistake on my chart there. So what we sort of know, or well, we know that low ending stocks for this year, but again, part of it will be is how much demand have we rationed? Have we rationed too much? Could we end up with a little bit more than we had expected earlier? It's possible. I wouldn't say that demand has acted desperately this year. Indian imports only so-so. Turkey, good but not great. And prices, I think, have been high enough that we've kind of weeded out some of the low price buyers out there. So I wouldn't say that there's been a desperation for Canadian lentils. Although again, as we get further into the later stages in the marketing year, some of that could emerge. So what will the acreage response? We're expecting a small increase. Production, well, a rebound, but how much of a rebound is, again, our best odds are only a partial production response next year. And then, as I talked about with peas, a shift in farmer selling behavior. And again, every part of the supply chain is hurting right now. And also no cushion for adverse weather, another year of adverse weather. In terms of longer term ideas, what I would have thought, especially for green lentils, is that there's very little demand elasticity. And so that was a little bit surprising to me, and for red lentils as well too, is that when we got to the price levels that some of the highs, is that demand really faded more than I thought it would. So where do prices need to go to trigger a bunch more buying? So that's, I would say from a longer term perspective, we'll see some of that. I think for lentils, again, Black Sea origins had really backed off in terms of lentil production the last couple of years, but they might become more, they might see some of these signals and decide to boost some production again. So become stronger competitors once again. I think that the overall global market and some of the domestic demand as well too is growing, and so we'll see that. And it isn't getting as much attention. So the milling and the inclusion of lentil flour or lentil components, fractions in food sources. Doesn't get it doesn't have it's not quite as sexy as peas, but the usage is still growing. And then again, like for peas, there are limits to Canadian acreage, but that isn't necessarily the case in other countries. So where could it expand? Well, places like Black Sea region would be the most likely ones, but also Australia has some room. Even in the US, there's room for more expansion. So that's, and before I leave lentils, I see a question in the Q&A. When does Australia run out of supply? Well, if you base it on their official production estimates, you would say probably about 6 or 7 months into their marketing year. But this year, or the year that they just finished, they were exporting 50, 60, 70,000 tons a month right up till their next harvest. So it really didn't tail off like the official estimates should say, or would say that it would. So they have become, and especially if they have a 1 million ton crop this year, they will be an export competitor for 10, 11 months of the year, for a good chunk of the year. So I hope that answers your question. I'll jump into chickpeas. And so what we see here is, again, we had fewer acres, and then of course a sharp drop in yields. And so what we have is we had a drop in production of 64%, so a little over, I'm just looking at the 75,000 tons, give or take. And so that was a sharp drop, and it's the third straight year of declines, just because until recently, the price signals just weren't there for that. So when we look at from a North American perspective, because really the Canadian chickpea market has become a lot less about overseas markets and much more about the US. And again, that domestic processing for food and for pet food, those types of uses. So it's become really that type of a situation. So both the Canadian and the US crop dropped this year. And that's what drove bids higher earlier in the marketing year anyway. And so again, once US buyers and the Canadian processors have bought what they need, other countries aren't willing to pay the 50, 60 cents a pound for Kabuli chickpeas anymore. And so that's why prices are starting to work their way lower, is to try and find some of that demand from offshore destinations. So in terms of Canadian chickpea exports that we're forecasting for this year, we carried over some sizable volumes. And so the export program that we're projecting is about 110,000 tons. But most of that decline, or put it another way, is that US demand is actually expected to be up somewhat from last year, whereas all other origins are dropping because they're more price sensitive. And so that's where we're at right now, and that's why that market is starting to fade a little bit as the US demand is being satisfied. When we look at Kabuli prices in a whole bunch of other markets, so this blue line here, dark blue line, is the average Saskatchewan bid, and in this light green is US Pacific Northwest, Argentina. Again, the Turkish currency stuff is doing wild things with their Kabuli prices when they're converted to US dollars. The purple line is India for Kabuli chickpeas, Mexico, and Pakistan. And so again, essentially, Canadian chickpeas are competitive in the US market, but aren't necessarily so in other ones. Mexico is an exporter, and these are for larger caliber, so 10, 11 millimeter or even larger. So that's what we're seeing is, and some of these markets prices are starting to soften. We don't tend to export into India at all, but as their prices drop, again, their exports, they export Kabuli chickpeas, and so they become more competitive elsewhere. So there is a limit on what these other countries are willing to pay for Canadian Kabulis. Well, what we'll have at the end of the year, and there's a lot of debate about what StatsCan's stocks levels are, some estimates that their stocks levels are far too high. So the bars on this chart are actually our estimates that we've made our own adjustments to. But by the end of this year, if the exports go as we predict, we're going to be dropping down to some quite tight ending stocks again. But in order to keep that export flow going, we'll need prices to keep coming back off those highs. So this stocks estimate isn't necessarily saying that prices are going to rally sharply again because of tight supplies, but there will be a fairly small cushion again. In terms of acreage, we're expecting a fairly sizable rebound in acres, partly because of some good signals for the few new crop bids that we have, but also in some of those areas, looking for alternatives to other crops in those areas. And even then, those acres, 250,000 acres, isn't ginormous by any means. It's better than last year, but still well below the last few years. And then in terms of yield, we've done the same thing as with some of the other crops, is we're using a 5% below average for yield numbers. So what that means is a good rebound in crop production, which is this yellow bar, but still not where we had prior to last year. And then if we have very low ending stocks again, we're going to have tight, even tighter supplies next year than we have in the current year. And so that's shaping up to be friendly for the market. But again, it's that US market that we really are really counting on for that demand, that higher price demand. When we look at some of the other countries, so Mexico is planting their chickpeas, and by now most of that is done, but the latest data we have is for November, and so that's this bar, the second the far right bar, I guess, is their November progress, and it's far higher than any other previous November in the chart. And so they're off to a very strong start, and that should suggest that ultimately they're going to come in with some pretty large final numbers in terms of acreage. And again, that's the larger caliber portion of the market. So there's that. In terms of India, their chickpea planting, now this is mostly desis, but Kabulis are included in here as well too. And just like with lentils, they started slow because of rains early in the planting season, but then caught up to average and are now, I believe, I'm going to say 8% above, 8 or 10% above, 8%, I think, above average. So there's the potential there. And I showed you the chart in the lentil section of good conditions throughout a good portion of India. So setting the stage for a decent crop there as well too. So in terms of chickpeas, this North American demand is strong, but the volumes needed are limited. There's a certain cap on those. And then the offshore business is more price dependent. So production will likely go up, across the fingers, in this next year, but supplies will still be on the low side. They're setting the stage for larger Mexican and Indian crops. So for that larger caliber portion, especially, there's a chance of some heavier supplies, global supplies, for those markets or for those types. And then there's this, as we've talked about before, farmers planting but not selling yet, and again, who can blame them? And also no cushion, even less cushion in chickpeas than for the other pulse crops. In terms of fabas, we had a 34% increase in seeded area this spring, but the yields were so poor that production ended up at only about a little over 70,000 tons. And so that is the that's the kind of a situation that we had in Western Canada, which makes it difficult. At the same time, though, we've had a very, very strong feed protein market with sky high feed pea prices, and faba beans have also benefited not only from that. The export market has been more of a challenge, and so Canadian exports are still tracking along kind of the lows, and this is largely, or a good chunk of this is related to lack of Canadian supplies, but I would expect that even if we had larger supplies, it would be a bit of a challenge to export faba beans, large volumes of faba beans in the current year. When we look at some of the prices, we've seen these are some of the benchmark locations. So France is in green, the UK is in yellow, and then purple are the Canadian average Canadian bids, and then the dark blue line is Australia. And so what we had was, we've had prices really strengthen, and this purple, the Canadian bids really took off, of course, because of the drought, but also because of those strong feed protein markets. Australia really spiked higher when there were problems related to harvest delays, but it's already come back down again. And I'm not sure if I have a slide of Australian faba production, but there have been estimates, I believe, as high as 800,000 tons of Australian faba beans. So that will really, really weigh on the export market, which is essentially Egypt, or has been. Canadian faba beans are increasingly headed to the US when they are exported. So that's kind of the price situation. But here's one of the reasons why Canadian faba beans will have a hard time this year in terms of production. So a little bit of an increase in France, a large increase in the UK crop, and then Australia, a large crop as well too, and in the Baltic countries like Lithuania, Latvia, a smaller crop, but a decent sized crop. So lots more competition in the marketplace. So in terms of faba beans, what we sort of know is that Canadian prices have been well supported. It's been the feed protein market that's really kept prices up. Export competition is back to where it's been a few years ago. From a longer term perspective, this new low lysine variety, I think, is probably going to be the key to expansion in the market. I think I'm probably late in or there are many others that have seen that before I have, maybe put it that way. But we really need that domestic processing. If we're going to have to compete against Australia, and we're going to have to compete against Lithuania and the UK and things like that, in the Egyptian market, we are going to be limited. So it needs to, the expansion will come from a larger domestic processing sector, and there's some positive signals coming from that. So that's what I have to say. I see one question from Ed White. What would be the implications of a possible currency crisis in Turkey? Well, Ed, I'm going to be facetious here, but it's no longer a possible currency crisis. It's a full-blown currency crisis. And really what it does is, well, first of all, the devaluation makes everything far more expensive for importers, Turkish importers. So that will tend to discourage trade. And then not just the devaluation, but the sharp moves from day to day or week to week, that puts the fear of God into into traders who are very, very nervous about what risk tolerance and all of those kind of things. Now, I'm not a trader. Someone may contradict me on that, but I think it does put bottom line is it puts a chill on Turkish trade, Turkish imports for sure.
Hey, Chuck, we also have Mary Clark with a hand raised.
Okay.
I'm going to allow Mary if you wanted to click to unmute.
Okay, I have to do that here somewhere.
No, I need to do that. And then
Okay.
Mary needs to also unmute on her end, on their end. And since Mary hasn't got that quite yet, we also have Robert Horn. So Robert, if you're able to unmute. All right. Can't seem to get Mary or Robert quite yet. Do we have anyone in person at Prairie Land? Carl, I think that's you up at the podium. I can't see the room, so you'll have to let me know.
There's no questions here
Okay.
at Prairie Land. Oh, there is one question. You need to go to the mic, Brad, please. Thanks. Oh, and we're supposed to keep our masks on too, at the mic too.
Just a quick question, Brad Gowdy with FABA Canada. Do we have an idea on FABA acres for this past year?
Yes, Brad, I will hang on. I've got my spreadsheet here because can't think without a spreadsheet. So what StatsCan talked about in terms of FABA acres in 2021 was
No, can you grab?
133,000 acres. So that compares to about 100,000 the year before. Did that answer your question, Brad?
He's just going back to the mic.
Sorry, thanks a lot, Chuck. I just got away from the mic there.
Okay, good.
Okay, it doesn't look like any more questions here for the moment at Prairie Land.
Okay.
Oh, I see. Sorry, I see a question in the chat anyway, or in the Q&A. Where do you see soybeans going? Well, right now, soybeans are in the midst of the turmoil in terms of the South American market. So southern Brazil and northern Argentina in particular, hard hit by drought. And so the market is seeing some sizable moves, some sizable bounces from day to day. And that seems to be the only weather market that's going on right now. And just for crops like soybeans, like corn, like wheat, we need to have a record crop global crop every year, just to meet the ongoing demand. And so the question is whether the drought in South America has already been priced in terms of soybeans. I would say that we're close. I think the market is already adjusting to the crop reductions that are starting to be forecast there now, of in the mid 130 million ton range in Brazil. So I think we're probably zeroing in on that. That doesn't necessarily make the market tight. That's not necessarily a small crop, but it's far lower than what the earlier expectations were for a Brazilian crop anyway, of 145 million tons. So we've already scaled that back, and I think most traders have already built that into their price projections. So generally sideways, I would say, until we know a little bit more about the US acreage intentions and how the spring starts shaping up there. Oh, okay, another question. Any quick comments on edible beans, specifically pinto and black beans? Yes. What we've had is the 2020 crop was very, very large, the largest in I'm going to say 10 or 12 years in Western Canada, and mostly led by pintos and black beans to some degree. And even in 2021, the Ontario crop had some exceptional yields. The Western Canadian crop, not so much, but managed to do a little bit better in the face of drought than some other crops did, I guess. And the eastern prairies, especially some of the bean areas, got some thunder showers and so on and so on. So it wasn't damaged as much. So smaller than the 2020 crop, But the difficulty is that our export program has been kind of hasn't been fantastic. It's been solid, but not fantastic. So we could end up with some more than comfortable or some comfortable pinto and black bean stocks by the end of the year. More comfortable for pintos, and blacks will be a little bit tighter. And so when we look at some new crop bids, not seeing much yet. But I would say that we're probably going to be fairly close to steady acres again next year. And again, I think the black bean acres might suffer a little bit more, which if you're a contrarian, that would mean some firmer prices there and a bit better price response. Yeah, I didn't have time to go into all the dry bean stuff in the presentation. Any
So I think
comment?
maybe just time for one more question if there is one. I think we're at time here now.
I see one in the Q&A or in the chat. Any comments on Canada's ongoing market diversification efforts for pulse exports? I mean, I'm not privy to all of the initiatives that are going on, but I would say that absolutely that's essential. And I would wholeheartedly support that, and probably more so than anything else, I would say more so in peas. So the diversification is as much into the U.S. and even staying within Western Canada. I think those are the most favorable markets to expand and diversify into, largely because they don't vary from year to year. That demand is strong and is pretty steady from year to year. So, but for peas, especially where we rely on China, have relied on China for 85% of our exports. That's one in particular where I see the need to diversify as one of the greatest.
Okay, thanks a lot, Chuck. That's all the time that we have for questions for this session. On behalf of the Saskatchewan crop organizations and the attendees, I want to thank Chuck for his presentation here this afternoon. The next session is the Saskatchewan